Hey everyone, welcome back to the channel, your number one source for income-oriented investing. I'm very excited to share with you the first episode in a brand new series I've been wanting to do for so long. Just haven't had the time to do it. But here we go. This is the first episode. This is going to be the first episode in the new covered call ETF battle. More specifically, covered call ETFs listed on the Canadian stock market. In case you're American watching this and you might be asking, what about the US ones? In the US, there's not many sector-specific covered call ETFs. So what I did is I made the Great series. So I have the Great S&P 500, the Great NASDAQ 100. I'll put the links in the video description below. Maybe I'll have a few more of that. But in Canada, we have a lot more sector-based and diversified covered call ETFs. There's going to be over 10 episodes. And for the first one, we're going to start with diversified Canadian stocks, diversified Canadian exposure. So in this series, in this video, specifically for the Canadian diversified, the criteria are very simple. Needs to be a covered call income-oriented ETF that invests in the overall Canadian stock market or a diversified basket of Canadian stocks. So if you're wondering, well, Adrian, where is CNCL or where is Bank or where is GLCC? We're going to have separate episodes for energy, materials, Canadian financials, US, global, etc., etc. I have so many episodes. I hope you like this series. Let's get started now with the Canadian exposure because of all the recent awesome funds like CANY, ECHI, HHIC that have come out recently. So we're going to go through all of them here, guys. And the goal of this video is really to give you the differences between. It's really up to you what you choose to put in your portfolio. But I'll give you my take on which ones I feel are, would be my choices in each category. So let's start more with the basic. And again, criteria has to be diversified on the Canadian stock market. So ZWC, the OG, right? It's been out there for a really, really long time. This is the BMO Canadian High Dividend Covered Call ETF. So the specific thing with this one is that it pretty much focuses on the Canadian dividend stocks. Right, so if you look at the holdings, you're going to recognize a lot of the companies, guys. The banks are there, Enbridge, some oil and gas, Manulife, Great-West Life. I'm not going to go through all the holdings, but you see very typical Canadian breakdown. Lots of financials, lots of energy, materials, industrials, utilities, things like that. So this one is specifically geared towards, especially if you only want dividend stocks. The yield is nothing special. It's only 6%. We know that BMO does a rinse and repeat cover call strategy, which I'm personally not a fan of. I'm not a fan of passive rinse and repeat cover call strategies. They typically do out of the money calls on up to 50% of the portfolio. That's why the yield is really low. There's no leverage here as well. Your management fee is 65 basis points, a really standard cover call management fee, but still very, very popular. Almost $2 billion in assets. Pretty much the biggest one here. BMO's just been around for a really, really long time. This fund has been around since 2017. Monthly distributions as well. Not much variation, by the way, with the distribution. Sometimes they go up, sometimes they go down. It really depends on volatility, but it's pretty much stayed 10 cents for a really long time. I think at one point it was a bit higher, at 11 cents, 2023. So you can go through the history here. Looks like it's pretty stable at 10 or 11 cents. Next is CNCC from Global X Canada. This is index based. This is the TSX 60, kind of like the S&P 500 for the US. TSX 60 is kind of like same thing on the Canadian stock market, except it's only 60 companies. So again, not geared towards only dividend stocks, but really the top 60 companies in Canada. So obviously it's going to hold CNDX, which is the Global X TSX 60, but they're actually writing covered calls they're writing index calls. They're writing TSX 60 index calls. So again, you have very typical Canadian, obviously, breakdown here. So here, the top stocks will be Royal Bank, TD, Enbridge, Shopify. So dividend and non-dividend stocks as well. So CNCC, and for all their index-based cover call ETFs, leverage or not, there is a leverage version. We'll take a look in a second. It is an active approach, but they'll never go over 50% coverage. It's typically around pretty much at the money calls near or a little bit less than 50%. So you could see here right now, the average coverage is just under 50%, and the moneyness is pretty much almost at the money, slightly out of the money. You have your management fees is nice and discounted here. It's 39 basis points. The yield is nothing crazy also, 7.39. We know that the Canadian stock market, Canadian stocks have less volatility than the American stock market. And in terms of the distributions, they had to lower them a little bit. Keep in mind, this fund has been around for a really long time, but they had renamed it. It used to be another fund. So I believe that, Global X Canada really updated everything in, I think, mid 2023 or something like that. I can't recall. But I wouldn't put too much focus on the performance of 10 years and since inception. I'm pretty sure this one's big cap Canadian, so it had similar stuff. But in terms of distributions, you see they had to reduce it a little bit from, let's go back to 2023. So yeah, I remember it being 10 cents for the longest time, 2024, and then they lowered it to 9 cents and now 8.25 cents. So that's, I guess, because of volatility. Volatility has gone lower, and if you see a distribution reduction, you might think something is wrong. It's just a measure of volatility, right? They'll increase it when they can, and they'll reduce it when they have to. So it's obviously very responsible for them to do so. So this is another one. This is index-based. Another index-based one, which I feel we're going to look at some total returns as well, guys. Really doing a great job is ETSX. This is actually the same concept as CNCC. It's pretty much the biggest competitor. It's also the TSX 60 with covered calls. I think what they do here, what's different, is that they're writing covered calls maybe on the TSX 60 index calls, but also on the individual stocks. And I think that's what really makes this strategy outperform just writing the index calls, as we'll see in a second. So this one, the 12-month trailing yield is slightly higher, 9.33. I don't know how they do it. Evolve really does a good job with this one. So higher yield than CNCC. The management fee, I believe, is 0.45. Yeah, it is 0.45. So this one's been around since January or early 2023. Monthly distributions. We'll see some of the total returns of what I like to feel are similar funds in a second. So this is another one that's index-based. If you like indexes, this is definitely one to consider as well. Pretty nice high yield. And they don't go more than 33% of the portfolio. So that's the difference. They're basically doing less covered calls, guys, than CNCC, right? CNCC, for example, right now is at 46.64% coverage. For ETSX, they don't go over 33%. So if the Canadian stock market has a really strong year or last couple of years, like it's been having, especially the last year, if you're writing less covered calls, you're capturing more upside, so it's going to do better, right? Next one is from Harvest ETFs, HLIF. This is not an index base, but it's just Canadian stocks with the classic Harvest covered call strategy, which I believe they don't go over 33% for this one. So it's not index based, but if you look at the portfolio, again, very typical Canadian breakdown, lots of financials, energy, utilities. You have the stocks here. Kind of looks like the TSX 60, right? But not exactly, right? Enbridge and Canadian Utilities, Amerifortis. You could sort by the sectors if you want here. Some other little ones that you don't typically see, like Quebecor. But again, still your big cap quality Canadian stocks. I believe there's about 25 to 30 stocks, and again, just like ETSX, they're not going to go over 33% of the portfolio. Okay, it's 30 stocks. There it is, 30 stocks. Management fee is 65 basis points for this one, and the distributions have been very, very, very steady, like your typical Harvest. They've actually never increased it. So the current yield's about 6.5%. They do have HVOI as well. This is very, very, very similar, except it focuses more on the low volatility stocks. So you could expect a little bit more stability, a little bit more probably towards the utilities stocks and things like that. So still a very typical Canadian, very typical Canadian breakdown. And I'm sure there's going to be a lot of overlap between this one and HLIF, but hey, if you just want a low volatility option that focuses a little bit more, like it says here, smoother experience, low volatility strategy. This one's managed, I know for a fact, managed by Chris Heeks, who used to be with BMO, who managed the BMO low volatility ETF, not a covered call one, but just a fun fact. So yeah, this one actually has 40 stocks, it looks like. So if we look at some total returns now, I just want to quickly look at HLIF versus HVOI. HVOI hasn't been around for a long time, but I just want to show you, let's look at some total returns now in this category. So HLIF is outperforming the low volatility one. Not really surprising, because when the market does really well, like it's been doing in 2025, obviously the more riskier stocks tend to do better. So HLIF is outperforming HVOI for now. But if we do the total return of CNCC versus ETSX versus HLIF versus ZWC, you clearly see that ETSX Evolve is the winner. Now, we don't have 3 years of data yet. We have, for all three of them, we have 1 year of data, but you could see that, 22% versus CNCC's 17.66. For a similar index, obviously the strategy is working better in ETSX, even when the management fee is slightly lower. So that proves a lot. HLIF, no slouch either though, 19.44, so it's doing pretty well. And in last place is ZWC. So again, this is why I'm not really a fan of the passive covered call approach. And again, ZWC's, I think, issue is that it can only have the dividend stocks in there. So something like a Shopify wouldn't be in there, which has performed really well. We have 3 years of data for these ones here, for CNCC, HLIF, and ZWC. And it's relatively close, but the Harvest one's actually outperforming after 3 years. So very, very interesting here. We'll get the 3 years soon, I guess, for ETSX. But I think ETSX is, and even the Harvest one here, are the clear winners in my opinion. Moving on, this is very interesting. So there's actually a 25% leverage version of CNCC, CNCL, and CNCL is outperforming CNCC by a tiny bit here. It is. But what I found very interesting is that even the leverage version is not outperforming ETSX, the Evolve one. That's very surprising to me, and it's quite a big difference here. So obviously, in terms of strategy, if you want a basic option, if you just want the index, ETSX a solid choice, especially if you don't want the leverage. I don't know why there's no 25% leverage of ETSX and even their S&P 500 one. By the way, ESPX, I think they would be amazing. HLIF did have a 25% leverage version, but not many people bought it, so they closed the ETF. But also another strong choice. But again, I found that, I had to tell you guys, because obviously we're looking at total returns here. CNCL slightly better performance in CNCC, but still underperforming ETSX. That's even with the leverage. So that just proves to you that, hey, ETSX seems to have been doing really, really well. Moving on to more leveraged options now. You have, of course, HDIV, which is the Hamilton Enhanced Canadian Covered Call ETF. I already know the first thing you're going to tell me. Adrian, this is about 70% Canada, 30% US. Why are you including it? You're right, but I still have to include it anyway because it's the majority is Canadian. This one is very special, guys. The total returns are absolutely undeniably amazing. You could see here versus the TSX 60, it's destroying it. Total returns are amazing. Yes, it is not pure Canada, guys, but it's mostly Canada. So you have a lot of, again, typical Canadian breakdown. Come on, get out of that. Why is it doing that? Sorry about that. Typical Canadian breakdown. Lots of financials, utilities. And if you look at what it has, so this is, by the way, $1 billion. It's about 10-11% yield. There is 25% leverage. What's very unique about this one is that it has covered call and also non-covered call ETFs inside of it. It's not a pure covered call strategy. HFIN, for example, holds the top Canadian financials with 25% leverage, no covered calls. HMAX is the same thing with the covered calls and no, but no 25% leverage. You have QMAX. So this is the biggest ETF that will give you access to the American stock market, which is technology. So I have plenty of Q&A videos talking about HDIV. And they basically, the idea behind HDIV is to have a similar diversification in terms of sectors to the TSX 60, but in terms of technology, instead of holding, I guess, Constellation and Shopify and the very limited technology we have in the Canadian stock market, they went with the US technology, which I think was a very, very smart decision. Obviously, making this ETF do really, really well over the long term. You have AMAX, which is gold producers, energy producers, and by the way, a lot of US oil and gas energy producers is actually mostly US in there. So this is, most of EMAX, QMAX, that's where you're getting mostly your American exposure. Even CDAY, which they added CDAY, is a technology Daymax ETF, which I really like the Daymax ETFs. They added it in here, and they also added CDAY as well, which focuses on quality Canadian dividend stocks. They just added it recently. I have a strong suspicion the distribution rate is going to go up because by removing the bonds and adding CDAY and QDAY, they're automatically raised the yield. So we'll see if they do that. I have a strong suspicion that they do. But HDIV, a very, very, very solid, fantastic choice, guys. CDAY also. CDAY, now this is, I would say, pure Canadian exposure. What they've done here is very, very unique. So this ETF holds two ETFs. It actually holds the S&P 500. You might be wondering how is this pure Canadian? But they're writing 0DTE at the money calls on VOO. So they're kind of, yes, they hold VOO, but they're giving up all the upside of the S&P 500. And this is how this ETF is generating very high yields. And they have no cover calls. And then the rest, or 100% of the portfolio out of 125 has no cover calls, and it's the Hamilton Champions Dividend Index ETF, which is this ETF right here that has 25 of the top blue chip dividend companies that grow their dividends over time. So you'll recognize pretty much all of them. Really, really good 25 stocks here. Again, very typical Canadian breakdown. So CDAY, guys, also a very, very, very strong choice for your overall Canadian, especially if you like dividend stocks that grow their dividend over time without any covered calls. So this is what's very unique because in my opinion, one thing I've noticed is that writing covered calls on Canadian stocks doesn't work as well as writing covered calls on US stocks because there's less volatility. So I have to give kudos to Hamilton. This is by far the most unique and innovative one out of all of them. Well, Class A is also very unique, which is next. But this is very unique because they're not writing the covered calls on the Canadian stocks. You have very high quality Canadian dividend stocks, diversified, no covered calls, but they added the VOO to write the cover calls just on the VOO at the money 0DTE call. So you have an approximately, now it's probably 17% yield. And by the way, semi-monthly distributions as well. So super solid choice, CDAY, HDIV, very, very solid. Class A, I added it to my portfolio recently. This is also very unique as well. It's a collection of the top split share funds in Canada, which mostly hold Canadian stocks. You have DFN, Life and Bank, Financial 15, North America, Brompton Split Bank, E-Split, etc., which holds Enbridge. Now, this is another one just like HDIV that's not purely Canadian. You have some split share funds, for example, Financial 15, North American Financial, that do have some US financial companies. There's also things like GDV, which has global dividend stocks. So it's not purely Canadian, but a lot or most of the split funds in Canada do hold Canadian stocks. So I guess I had to add this one to the list. It's very unique because if you like split funds and you don't want to deal with missing dividends or picking and choosing your split funds, this is a great ETF. I've had several conversations with Brompton about it. I highly recommend you check them out. Just go on my channel, click the little magnifying glass to search videos and put CLSA and you'll find the videos. I did one recently with Michelle. Very interesting ETF. And I just want to show you the total return so far of Class A. It's pretty much been beating everyone. It's even been outperforming HDIV But of course, split share funds, which have a lot of Canadian financials, have skyrocketed lately. And of course, the split funds will skyrocket more because they have a lot of leverage. So this is, very short term, short notice. It's not even a year of data, but just to show you how powerful split funds could be, especially financial split funds have been doing really well. They even already increased the distribution from 10 cents to 11.5 cents. So this one's going to have about 12% yield. They have a 12% yield target on this one. So another very, very interesting way to get, let's just say, mostly exposure to Canada. Okay. Last but definitely not least, you're probably wondering, we have HHIC, which is the Canadian counterpart, if you will, to the beloved HHIS. So this is 10 stocks, covered calls on up to 50%. They could go to 50%, but Harvest is very comfortable more in the 33% range, 25% leverage as well, right? So you could buy the single tickers, which is, just holds Shopify, just holds Royal Bank, just holds TD, just like the high income shares in the US side. When I mean US side, I mean the Harvest US side. But HHIC is the all-in-one solution that will have these 10 stocks. So you're essentially investing in these 10 stocks, which are Canadian staples, right? TELUS, Bell, RBC, Suncor, Shopify, TD, Canadian Natural, Enbridge, Cameco, and even a gold company here, Anico Mine. Where is it? Anico Eagle. So some gold in there. So diversified Canada, purely Canada. There is diversification. Very high yield, about 16% yield on the initial price here. So this is actually very, very popular as well. Management fee is 40 basis points. Sorry, I forgot to cover the management fees on a lot of these. But HDIV is pretty much 65. CDAY is 85. And Class A, I believe, is 60. Right? Yeah, it is 60. And keep in mind that the MER is going to be high as well, because Brompton is basically paying the management fee for the non-Brompton split funds in here, which has quite a few of them from Quadravest and Middlefield. 40 basis point management fee here. So if you want a little bit more concentrated portfolio and you like these 10 stocks, this is a great option. Of course, people have copied HHIC. You have Ninepoint well, I don't know if they copied it or not. I can't say that. Ninepoint's ECHI, very, very similar concept, except right now they have a 0% management fee until March of 2026, and then it's going to go to 29 basis points. So the fee is lower. Very, very similar concept. A lot of the same companies, but some different, right? They have Barrick instead of Anico, but they still have the Suncor, the Shopify, the TD, the Royal, the Enbridge. So companies are a little bit different. Still 10 companies, and again, I have 2 interviews with Ninepoint talking about this with Carl. I highly recommend you check them out as well, where we discuss especially ECHI in detail. But this is also 25% leverage, just like HHIC, and covered calls on no more than 50%. The main difference, I think, between HHIC and ECHI is that it's yield weighted, which means the more volatile the stock is, the more weight it's going to have. So you see Shopify and Cameco are by far the 2 most volatile stocks, and they have a little bit higher weighting, but the cap on each one is 15. So they can't go over 15 for any one name, but they will go a bit higher, like you see here, for the more volatile stocks. Even Barrick's a bit higher, for example. Barrick, Shopify, and Cameco is much higher than CN, for example, or RBC, which have a lot lower volatility. And then you even have Canadian Natural and Suncor, which are slightly higher volatility than Bell and RBC, but lower volatility than Cameco and Shopify. So you see, it's basically yield weighted. Still diversified among sectors as well. Last but not least, you have Evolve that launched their own as well. Very, very similar. CANY, Evolve Canadian Equity Ultra Yield ETF. The biggest difference, by the way, management fee is 40 basis points, just like HHIC. So in terms of, with these 3, which I would put in the same category, ECHI is the lowest management fee. CANY has the highest yield, though, because they have 33% leverage instead of 25%. That's a big, big difference. Also, Harvest and Ninepoint, it's monthly distributions, whereas CANY is semi-monthly distributions, just like CDAY. And the stocks are a little bit different. There's 10 stocks. A lot of them are the same. You have Shopify and Cameco, right? But you have CP, and you have Brookfield, Bank of Nova Scotia, Bank of Montreal, Thomson Reuters. So the 10 stocks are a little bit different. 33% leverage instead of 25. I talked to Raj, the CEO, all about this one in a recent video, so you could check that out as well. In terms of total returns, I mean, we could do HHIC versus ECHI versus CANY, but there's not even a year of data, so this is it's not much data, but right now I believe out of all of them, you could see HHIC and ECHI very, very close, but ECHI has a little edge. And if we do ECHI versus CANY, again, not much data here, you see that ECHI is also outperforming CANY. What about HHIC? I'm just curious here. Yeah, HHIC is outperforming CANY as well. But again, very, very early, guys. After a year, 2 year, couple of years, we'll have more data. So that's the entire lineup of the diversified Canadian covered call income-oriented ETFs. That gives you access to diversification within Canadian stocks. Again, not exactly, HDIV has a little bit of US, Class A has a little bit of US, but the rest are pretty much focused on Canada. If you ask me my favorite ones, well, it's very, very hard for me to say. As a very basic option, if you don't want the leverage, I think ETSX is a strong choice, especially if you like the index, the TSX 60 index. I really wish there was a leverage version of this one. It seems like the strategy is working better than the Global X one. HLIF is no slouch either if you like Harvest and their consistency, their reliability. In terms of, you guys know that I really like the leverage. I think HDIV is a very, very strong choice because you have a little bit of US in there. You have the track record. It's really awesome. CDAY, by far the most innovative, very, very high yield. This is also a very special one to consider, in my opinion. Semi-monthly distributions, even Class A. I actually added this one to my portfolio. Split funds are very underrated. There's not a lot of information out there. Of course, on my channel there is, but this could be a very, very strong choice if you like split funds, but you don't want to pick and choose them, and you trust Brompton, who I believe is the best split share fund manager in Canada to manage that for you. So very, very strong choice. And if you like the higher yielding, more concentrated portfolios, well, between HHIC, ECHI, and CANY, I can't say which ones is my favorite or not. But each of them are very, very similar. They have a lot of similar stocks, but have a little bit of differences between them. Again, there's nothing wrong with mixing and matching either, guys. So hopefully this video was informative for you. What would you like me to cover in the next cover call ETF battle? Do you want me to do maybe US? Do you want me to do energy, materials, like gold? That's very popular now. Let me know what episode you'd like to see next in the comment section below, and see you in the next episode. Take care, everyone.